everybody, and welcome back to another episode. I'm your host, Brandon Cobb, co-owner of HBG Capital, and today I've got Stewart Heath on the show. Stewart Heath founded the Harvard Grace Corporation in 2010, which has since expanded into Harvard Grace Capital. Harvard Grace still provides fractional C-level executive services to clients as well as general business consulting. Heath sits on the boards for HGC and Freedom Business Alliance. He holds a bachelor's in business administration from Auburn University. And I'm excited to jump in today about interest rates, why he likes office buildings, which is crazy because that's getting a lot of backlash right now. I'm excited to jump in today. Welcome to the show, my friend.
Thanks, Brandon. It's a pleasure.
Yeah, absolute pleasure hanging out with you. I know we were at Raise Fest not too long ago, hanging out. For those that don't know who you are, what's your story?
Um, I'm a Middle Tennessee native for the most part. Born in Birmingham, moved up to Nashville pretty early. I've followed that market my entire life. I am a CPA. I followed my dad in that path. Only after I had gotten the degree and started to work with one of the big eight accounting firms did I realize, oh, I'm a whole lot more entrepreneurial than most CPAs. And so have started many businesses along the way, some of which are still in business, which is kind of funny, but yeah, that's the entrepreneurial path. You try a lot of things. After watching clients for years, um, get rich slow, essentially doing real estate, holding rentals, doing fix and flips, things of that nature. I said, well, why don't I try that? And I kind of got into it in 2001 and just really fell in love with real estate and have made many mistakes along the way. And here we are many years later, and feel like we're doing it the right way, building it from a cash flow standpoint. And I'm happy to be able to help investors have cash flowing investments, which I think is the foundation of everybody's investment portfolio is cash flow. Anyway, that's where we come from. I approach all of this from a CPA, a bean counter's point of view, because really, yeah, most real estate really just comes down to the numbers if you want to get down to it. So
Bean
you might
counter.
you might hey, I'm a numbers geek. I can't help it. So
I haven't heard it called that. Well, so when you say approaching this from the right way and building that sturdy foundation, I mean, tell us more of that. Your
yeah.
strategy is obvious. You've been doing this a very long time and your strategy is involved. I mean, what does doing it the right way look like?
Well, so back in the early 2000s, I was doing this pretty much all by myself, and it was easy. Banks were easy credit, and I parlayed one duplex into 30 duplexes, and from there I was doing home building, and after that I was rehabbing condos, and just doing what they call the equity ladder, and refinance this one to go buy this one, and so I was doing it all without any real hard capital or reserves, and that cost me dearly. And so as I've gotten back into it, we structure every deal with 12 months of reserves inside the deal because you don't know what you don't know. Even our deals, which are kind of boring, stabilized deals, you don't know what you don't know.
Yep.
And 12 months is probably twice as long as you really need to react to some sort of a
Yeah.
crisis. And so I don't ever want to be in a position where I have to call, partners for a capital call. So most of our deals just have a fair amount of cash just sitting in the bank, and which is not so bad these days where you can get 5% on it, but a few years ago when you weren't making anything. So nevertheless, that still will push down our returns a tad,
Yeah.
but nothing like pushing down the returns if you end up losing a property or having to call people to kick in more deal. So To me, that's doing it the right way. You're preparing for the downside, even though everything looks up. So to me, that's what I mean by the right way.
Yeah, you can't build that foundation, that safety net enough. It's interesting. I would have, back when we had underwritten about 30 new builds in Q4 of 2021 and started those in the spring of 2022. Guess what happened right afterwards? Construction prices shot through the roof. Inflation was crazy. And again, all their underwriting was done. The loans were set. It was ready, set, go. And you had these, the interest rates double. And so when you have a construction loan, it's a floating rate. You can't get fixed construction rate debt. And so we watched as our monthly rate doubled, and not just the monthly rate doubled, but the timeline doubled. So we had underwritten these homes where, all right, 12 months is usually when we're in and out. Like there's no way we should be able to build and not sell these 30 homes in 12 months and get in and out in a year. That's what we've done in the past. That's what we knew. And I had built an additional 12 months of reserves in. I was like, no way I need 2 years worth of interest payments on these things. Boy, was I wrong, and boy, am I glad that I did that. And we were able to skate by and avoid a catastrophe because we had all that. But I would have never guessed in a million years that we'd needed that. So props to you for being able to put the liquidity in there and be able to make sure that that safety net is there. I know everybody's talking a lot about interest rates. Tell us a little bit about your investment strategy. What do you see as attractive right now? And I know you're the guy that's known for not caring about what interest rates do. Tell us more about that.
Well, that's more of sort of bean counter speak. I have, when you deal in stabilized properties, i.e., it's already leased up, it's already stabilized. It's a property that has already met its business plan essentially. Um, you don't have in your world you don't have this luxury, um, but I don't care what the interest rate is because I'm going to buy it at such a rate that I'm going to get some positive leverage between the cap rate and the interest rate. So if interest rates are at 8, I want to be buying at an 8.5 cap rate or 9 or better or higher, so that I'm going to get a little bit of margin in there. So to that extent, I don't care where the interest rate is. The interest rate is simply a variable in my calculation of what I'm willing to pay for a property. You know what? And last year, by using that, we didn't do a whole lot of deals. Sellers
Yeah.
were not quite adjusting to the interest rate market. This year, it's a whole different ball game. We've been underwriting like crazy, and we have several deals that we're working on. Walked away from some, but still, the interest rate is a factor, and because here's what we like to deliver: a stabilized property that will throw off a minimum of 5% cash on cash to the investors. And so you sort of start there and you back your way into what you think the NOI on the building will be, because your net operating income will always be somewhat different from what the seller is, because your insurance premiums will be different than his, your tax rate's going to be different than his. So you got to back into what you're going to get, and then that tells you what you can afford to pay based upon today's interest rates. So that's what I said. I don't care, as long as the seller really wants to do a deal. And sometimes you don't have a meeting in mind. Sometimes you don't get a deal done, but we back into where we want to be because we're going to deliver cash flow from day one.
Yeah, makes sense. And what asset class is this? Is it we talking multifamily, commercial?
I'll say anything commercial. Some people, pursue and target one particular asset class. I don't think that's wrong. I think that can be smart. We have focused on a geography, which is southern Middle Tennessee and northern Alabama. So we're a little bit asset class opportunistic. We've not done any multifamily yet. It's always exceptionally high priced, and there's a lot of competition on those deals. But so we do storage, we do suburban office, we do medical office,
Okay.
we do retail.
And
So
so you're saying that the interest rate, you're building your offers into this interest rate, right? You don't care what it does because you're locking in long-term fixed rate debt
that's
that's
correct.
not going to adjust on
Yep.
you, and you're buying stabilized assets that basically cash flow from day one. I
Yep.
mean, it's
Yep.
it's 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 got money coming in day one. Are you having success finding really good deals? Because usually assets like that, it's people command a premium. Sellers want a premium for it because it's kind of wash your hands, said and done. It's leased up, it's cash flowing. Here you go. It's usually they've got some unrealistic expectations of what they're asking at this point, because a lot of times the good deals are ones that got hair on them, right? Or at least that's the limiting belief people have. There's something that's got to get fixed, there's some sweat equity that's got to get done, there's some kind of pending problem. What are you seeing? Like, what are you going after?
You're absolutely right. Some of the best deals have a little hair on them. So we don't do anything that's sort of construction or development oriented. But that doesn't mean that we don't have a value add approach. Sometimes you can get a property at a good price and you realize that for 20 years they've been doing their leasing all wrong. Well, that's your opportunity. You have to live. You have to live throughout the lease period that exists. But if you can get in there and get it up to market rates, put in a proper professional lease with annual increases in it, and that's just one example. Sometimes you just need to give it a paint job and maybe seal the parking lot, update the landscaping and things like that, and then you can start getting your street rents up to the appropriate place. And you know the stereotypical situation really never exists. You
Yeah.
said you got your professional asset managers out there, and they're going to be what you just described a minute ago, and that's probably not a deal we're going to be able to do. They might sell that property to a family office or something like that. But there's all kinds of sellers. We buy from individual owners. Maybe it's a 15,000 square foot building for $3 or $4 million, and maybe they didn't necessarily have the skills they needed to be a great asset manager.
Hmm. Yeah.
And a lot of times you find people who take really good care of the property, but they didn't really know what they were doing with long-term leases. And long-term leases are a completely different animal than, say, multifamily, where, oh well, if I make a mistake, I fix it next year at renewal. So when you're doing 5 and 10 year leases on an office or a retail property, you got to build it right,
Yeah.
and you got to make sure that you're not eating the cost increases that the tenant is. So.
So talk to us about office buildings. I know you invest in this asset class. There's been a ton of news recently over the past year that this is dead, right? The commute to town is dead after COVID. There's a lot more people that are working from home. A lot more people are happy. Recently, a few months ago, early this year, the San Francisco downtown office building was like vacant and it was going to go back to the bank. So office buildings, not exactly the darling investment, especially in the real estate world, but you like to invest in them. Why?
I do. Well, office being declared dead, it makes about as much sense as commercial real estate has been declared dead. I mean, it's real estate is the single largest asset class in the world, and it's made up of massive, massive subclasses. So even under the office subclass, there are subclasses of office. So we don't like all of them. I don't do Class A office space, and I don't do downtown or central business district. But a medical office building, they've
Hmm.
never had any trouble. Your doctor's not going remote and he ain't coming to see you. So, they put hundreds of thousands of dollars of TI work into their space. And then they put machines and equipment that we don't even understand in there. So the medical office class is just about as strong as it's ever been, and we still have an aging population, and the need for that space is has not slacked back at all. So MOBs are awesome. My other favorite class is what I call
Real quick, I like what
suburban.
you said
Yeah,
there.
yeah,
I want to highlight that
yeah,
so a good framework to look at this if you're considering investments is, what's the tenant base? Like you
yeah.
said,
What
that
it all comes
doctor,
back
he
to
ain't
anyway.
working from home. Like he's
Right.
he's got a business to run. And your tenant, you got to think like, where's the money coming from? If you're going to invest your money as an investor, passively or actively, how do you know that loan, that bank loan you're going to take out on that building, the equity that you raise from investors or your own equity that you put in the deal, how do you know it's going to get paid? It's your tenant, right? And so
Yep.
you just highlighted something support, like who's your tenant base? Like that doctor who's got a successful business and all that equipment there, and he's licensed and he's got a practice. I mean, that gives you a lot of comfort. I didn't think about that. So going after the
Yeah.
office
Well, you
opportunities
you
where
drill down to really the core. It's my rule number three. Whatever business your tenant is in, you're in that business too.
you're in that business too. I like that advice.
Yeah, and yeah, I wish I had thought of that originally, but I didn't. So yeah, and similarly, my other favorite class is what I call suburban office.
Mm-hmm.
You know my neck of the woods, so we have an office building down in Spring Hill, Tennessee, right next to the post office down there, and I was managing it before we bought it, and it was full before COVID, through COVID, after COVID, and it's still full today. And we've managed to get the rental rates up and up and up and up. And but it's an office building, and it's 30 miles from downtown Nashville.
Yeah.
And there's nothing like it in a 10-mile radius.
Because that's where all the pressure is moved to. I'd
Yeah,
argue that people who are
yeah,
like against office space because of COVID, right? No
yeah,
one's downtown anymore. Like you said, yeah, downtown Class A buildings,
yeah,
yes, you're seeing those suffer a
yeah,
lot, but that's actually pushed more demand to the suburban
yeah,
office buildings that people are living next to, right? The local
yeah.
hairdresser shop that you want to go to, or the local fast food restaurant, or what have you.
Yeah. Yeah. So, suburban office to me is state farm agents and mortgage companies and dentists and just people who need a space. And again, kind of what you drill down on immediately. These are people who meet, they're consumer facing, and they see their customers at that location.
Yeah.
It is the places where employers just had gathering spots for employees that the employees don't want to go to anymore. That's what's struggling, and we're going to need a few more years before office owners, Class A office properties, they're the ones who are going to need to figure that out. So
Yeah, that's the big ones. They're talking about the condo conversions, but I don't think people realize how difficult that is to pull off a
that's
condo
going to be
conversion like
very
that.
rare. You're right.
Yeah,
Yeah,
extremely expensive, very rare in how the
yeah.
architectural design was set up. With with everything that you're focused on, the office buildings, the commercial, everyone's talked about for like a year and a half now about this wave of bridge debt coming due. It's going to be the best buying time ever in commercial real estate. Are you starting to see some of those opportunities present itself? Are you starting to see some desperation in the market that you're in?
Only in individual situations. As a general market, no, I'm not. Yeah, I think you and I operate in some pretty healthy markets.
Yeah.
I think, I mean, the Huntsville market that I'm intimately familiar with, Nashville. I mean, there may be some development people who are struggling because rents didn't increase like they thought there would, and there's always going to be some one-offs. I think that's going to be highly regionalized.
Yeah.
We've been hearing about this since the fall of 22, that the debt wall is coming, and every time you read about it, somebody has pushed the wave out another quarter or so.
Another quarters. Yeah.
Yeah,
Yeah.
yeah, and frankly, I think it's going to be hitting mainly city centers in great big cities, Chicago, LA, San Francisco, and places like that. Everybody's going to feel a little bit of it, I believe. But I don't think it's sweeping across the South, is where I'm kind of going. Birmingham is another market we're familiar with, very strong market. And these are markets that never ran up way too high either.
Mhm.
They've done well and they've stayed healthy, But generally what goes up really high also comes down pretty fast. And hopefully you didn't do your pro forma when it was way up here.
Yeah.
So
Well, what do you think is those distinguishing factors for the markets and the submarkets that are going to do well versus the ones that are going to really take the brunt of this, wave of debt coming due? I mean, because, the debt doesn't discriminate, right? Like, why do you think certain areas are going to be more affected than others? You kind of named a couple.
yeah. Um, well, these are areas where the economy is generally has been pretty healthy. And not to get political, but these are areas that generally did not. Uh, let's just say relieved the COVID restrictions quicker than other
Yeah, they're
parts
more
of
the
the
more
country.
conservative states,
Yeah,
right? Yeah, you've got
yeah.
business friendly states, you got non-business friendly states, highly
I think
regulated
that's what it
states,
comes down to.
highly regulated states.
I
Yeah.
don't I don't want to I don't want to talk colors, but like blue and red. But Florida never put on restrictions.
Yeah.
Tennessee had limited restrictions and they went away pretty fast. Alabama, same thing. Georgia got rid of theirs very early on, and their economies have just kept on turning. And I think there were some trends already in place. There's a lot of people leaving Northeast and Western states, and they're moving to Texas and the South. And so,
Yeah.
and every time you've got population flows, that's a real
Business is
estate
going to be,
opportunity. Yeah.
yeah. So it's really the population growth and the healthy economies that's
Yes.
feeding these, right? So if you own some, let's say you've got a troubled asset, call it an office building in uh, San Diego, California, per se, versus a troubled asset that's in Texas, you've got a lot of those safeguards built in with the local regulation. Texas very landlord friendly, not going to put a lot of restraints on you. And here you've got that asset in California, same asset. It's under some distress and there's a lot of constraints, right? There's rent
Yeah.
controls, et cetera. There's a lot
Right.
of bureaucratic tape they got to go through. Can't necessarily get unpaying tenants out quite as
Right.
fast. And so the
Exactly.
environment that these real estate assets are sitting in is influencing the performance of these. And so, kind of like when you fill that bucket up a little bit too much and it starts pouring out, if you get too much stress on a real estate asset, it starts overflowing. In other words,
Yeah.
goes upside down and goes back to the bank. And those pressures, those societal pressures, the area, the city, the economy that it's in, that could be just enough to fill that bucket up too much where it turns over and that water starts pouring out, or too much
Yeah.
stress on the asset and it goes back to the bank.
Yeah. It simply put, I think that's an excellent example. Simply put, my rule number one is all real estate is local. And it's, when you're looking at buying some, it's hyper local because, even in just our Nashville market, there's all kinds of different markets in there. There are good pockets and bad pockets, and you don't want to buy over there, but where the asset is located is the key.
Yeah, that's a big part of it. Now, I know that you've got a specific deal here in my market, actually, in my area,
Yep.
that you're going to be looking at pretty soon. Give us an idea, like what does a really good deal look like? What should investors be looking for in, this current economy, especially if they're new and looking to invest?
Yeah. If you're new, I'm gonna preach to you about cash flow, cash flow, cash flow. Um, and so this deal that we've got coming up is a new construction. And I already said I don't do that, and I'm not doing this one. We're buying this one as soon as the CO has been issued. It's already been leased up. It is a retail building in the Spring Hill market, and which has just been going crazy since GM put a plant there back in 1988. And lots of houses around, and there's a new pocket of retail being developed right here at this location. Like I said, it's already been leased up. They did a fabulous job of constructing the leases. So as a new investor, what you should be looking at is, all right, what's the debt load? There are basically three kinds of risks. There's development risk. Those are the things like Brandon has the guts to go and do, and there's interest rate risk, and then there's vacancy risk. So when we structure a deal, we're going to eliminate two of those because we'll only do fixed rate debt. We won't have development risk because that's already been done for us. because we acquire a stabilized building. So the only real risk that any stabilized property will ever have is vacancy risk, and there's really no way to get away from that. The best way to mitigate that is professional management, which we bring, and we're analyzing these leases along with the seller and the people coming have good financials themselves. We're a little bit like a bank because being a landlord is an extension of credit to these people you're letting into your property. Yep. So, and when you do all that, you should be looking for something that's going to cash flow from day one. Again, ours will be a minimum of 5%, and then they should be going up over time. And you might ask your sponsor, when interest rates come down, will you refinance? And, that's always in the back of our mind, because if the property works at 8.5%, it's going to sing you a song at 6.5%. And that's just more money in your pocket every quarter, and so forth and so on. So
I love how you laid all that out. With all the success that you've had, what's next for you?
More of the same. I mean, we're going to take in probably bigger markets. We've just stepped down into the Birmingham market, which I think I told you before we went on air. And we're doing a medical office building down there. So I have been resistant to go north of the border. As I say, I don't want to cross Williamson County and go up into Nashville. A lot of competition up there, although there's been some people dangling deals in front of us up there. So we're probably going to keep expanding north and south along this I-65 corridor, which has been sort of like the lifeline of my life. So and so we're going to just keep expanding territory. We do worry that there's not enough stabilized deals in our price point, just in our market right now, that we're going to have to keep expanding our territory. So
very cool. My favorite advice from this episode: whatever business your tenant's in is the business that you're in, whether you know it or not.
Yeah.
I love that advice. If people want to learn more about you, learn more about potential investments, where should they go?
Please go to harvardgrace.com. We've got free resources that'll cost you nothing but your email address. If you navigate over to the contact, you can find my Calendly link and you can book some time with me. I do invite sincerely anybody and everybody to book some time with me, because I can talk real estate all day long.
All right. We'll make sure that that gets posted in the show notes. It's been an absolute pleasure having you on, my friend.
Thank you, my friend. Thank you, Brandon. It's been an honor.
Hey, and if you get value from this episode, show Stewart some love, show me some love, leave us a review, subscribe to the podcast, and share it with your friends and family. We'll see you guys next time.